Are you an investor looking for premium market opportunities? Presenting premium and exclusive service for investors by Kalkine.
Value investors often lap up undervalued stocks. The primary reason behind their attractiveness to value investors is their margin of safety in their valuations. These companies are known to have attractive growth prospects in the long term, but the shares of these businesses generally trade at market value lower than their intrinsic value. In comparison, while undervalued shares have a market value lower than their intrinsic value, overvalued shares are the opposite. So on that note, let's explore how investors can assess the intrinsic value of shares. The first and foremost factor, looking at the value of the shares. A share's value mainly depends on the company's fundamentals. Income investors generally buy undervalued shares with the belief that the stock will realize its actual higher value in future. The difference in the value would add to the profits of these investors. Now, there are several factors that determine the undervaluation of shares. The first one is the share market scenario. The undervaluation of shares is mostly an after effect of weakness in the share market. There are times when the overall market crashes due to reasons including a herd mentality and overinvestment, rendering several stocks undervalued. This is why investors need to be aware of the ongoing market conditions to determine the share's valuations. The seasonal nature of a business can also affect this. This has a direct impact on its top and bottom line. In a year, there are times when a company's production and sales peak. Other times, the company performs at its weakest level. Therefore, every business shows cyclical behavior. This is why a low demand for the company's products or services is seen in terms of weakness of its shares. A company's share price is bound to be undervalued during a decline in its sales, even if it has strong fundamentals. The PE ratio and P/B ratio may also help an investor determine this. The price-to-earnings ratio is a metric that tells us how much investors are willing to pay for $1 of earnings. Generally, a stock with a P/E ratio below the industry average is considered undervalued. Low P/E typically translates more profits against the price paid for shares. Value investors closely look at firms with low P/E ratios to maximize their profits. The price-to-book ratio is the ratio between a company's book value and the price per share. This reflects the financial strength of a business. A low market value, compared to the book value, is the mark of the best undervalued shares. Now that you're up to speed, hit that bell icon and subscribe to boost your financial IQ. I'm Holly Shields for Kalkine Media.